Okay, so ever feel like you're just drowning in financial news? One
Well,
minute it's crypto, the next some hot stock tip.
yeah, it's relentless.
Right. And if you're just trying to find a solid path for, long-term wealth building without needing a PhD in finance or being glued to a screen 24/7, well, you're definitely in the right place.
Hmm.
For this deep dive, we're tackling a listener question, one that I think probably resonates with a lot of you. What are the real core principles behind successful long-term investing?
And we figured, let's cut through all that noise. Let's go straight to, well, one of the greats. We're diving into The New Buffettology by Mary Buffett and David Clark.
Exactly. Learning from the source, or as close as we can get. This isn't about finding the next overnight sensation.
No get-rich-quick stuff here.
Definitely not. We're after, let's call it a shortcut to understanding what actually works over time, focusing on the businesses themselves, the actual companies, not just the stock market casino.
And hopefully you'll have a few of those aha moments along the way, things you can actually, take away and use.
Yeah, practical insights. So the new Buffettology, it lays out Buffett's strategies, right?
It really does. It's a great guide. It traces how his thinking changed over time.
Yeah.
Starting with Benjamin Graham, the classic value guy.
Right. Buy cheap?
Kind of, yeah. But then, crucially, incorporating ideas from Philip Fisher and, of
Yeah.
course, his longtime partner, Charlie Munger, they brought in this focus on superior economics,
Mm.
quality businesses,
So it evolved.
big time. And a core idea, maybe the core idea we'll dig into, is looking at stocks as owning a piece of a real business, not just a ticker symbol.
Okay, so our mission for this deep dive is pretty straightforward then. We want to pull out the most important, the most actionable ideas from the book.
Help you start thinking like a successful long-term investor, someone who can tune out that daily market chaos.
And make smarter choices. Okay, let's get into it. The first big thing, this huge shift in perspective the book talks about, it's owning versus just trading.
That's it. Buffett's point is, you don't really get a company until you own a piece of it. It changes everything. Well, think about it. Suddenly that annual report isn't junk mail. It's an update on your business. You start actually paying attention to news about the industry, the competitors.
Because it affects your investment.
Exactly. The totally different level of engagement compared to just watching a price wiggle on a screen.
Makes total sense. You're an owner, you care about the long-term health, the profitability. It's not just about the next tick up or down.
Which is so different from the typical Wall Street focus, right?
Yeah.
The quarterly earnings game, the constant predictions.
The noise. Buffett's famously said he doesn't really care what the Dow does day to day. No time for tips or, what's it called, the efficient market theory.
Right. The idea that everything's already priced in, so you can't beat the market. He doesn't buy that.
His focus is much deeper.
Laser sharp. On the individual business, he digs into the financials, understands the operations, figures out the competitive edge if there is one, and if it lasts. It's real fundamental analysis.
And this leads to thinking about stocks in a really interesting way the book mentions, like bonds with variable interest rates. Talk about that.
Yeah, it's a great analogy. Instead of a fixed coupon payment like a bond, your interest from owning a stock comes from the company's earnings, its profits, and how the value of the business grows.
But it's not fixed.
Exactly. It's variable. It
Oh, that's-
depends on how well the company actually performs over time.
Okay. But Buffett wasn't always investing exactly like this, was he? The book talks about an evolution.
Oh, absolutely. Early on, he was heavily influenced by Benjamin Graham, the father of value investing.
Graham was all about finding bargains, right? Stuff that looked cheap on paper.
Pretty much, based on the balance sheet assets minus liabilities, looking for companies that were maybe out of favor, even struggling a bit, but seemed statistically cheap.
The whole cigar butt investing idea, finding one last puff.
That's a good way to put it, yeah.
Yeah.
But then came Fisher and Munger. They really pushed him to look beyond just the price tag.
Towards quality.
Towards quality, what they called superior economics. Finding really great companies with durable competitive advantages, solid management, and real growth potential.
So it wasn't just about finding anything cheap, but finding something great at a fair price.
Exactly. A big shift from bargain hunter to quality seeker.
It's fascinating how that thinking evolved, building on what came before.
It really is. And to make this business owner mindset really concrete, the book uses a simple analogy. Imagine you're thinking about buying, say, the local corner drugstore.
Uh-huh.
What's the first thing you'd want to know?
Well, is it actually make money? Show me the books. What are the profits?
Right. Then are those profits consistent? Is it steady, or does it boom and bust with the seasons or something?
Yeah, reliability matters. And then, What could mess it up? Is a giant chain moving in? Is the neighborhood changing? Sustainability.
Exactly. Long-term sustainability. And then the bottom line.
The price. What are they asking? Does it make sense given the profits and the risks?
And that, right there, is basically Buffett's approach to a public company. He's looking at profitability, consistency, sustainability, and whether the price for a piece of that business is reasonable.
Thinking like you're buying the whole thing, even if you're just buying shares. Okay. Now, the book talks a lot about retained earnings. Why are those so important?
This is super important, and where Buffett often differs from Wall Street's short-term view. So, a company makes a profit. It can basically do two things: hand it out to shareholders as dividends.
Get a check in the mail.
Right. Or it can retain those earnings, keep the money, and reinvest it back into the business. Maybe expand, develop new products, buy back stock.
And Buffett prefers they keep it.
He strongly prefers they keep it if, and this is a big if they can reinvest it profitably.
Because that reinvestment grows the actual value of the company over time?
Precisely. Even if you don't get that immediate dividend. He believes the market, eventually, will recognize the growing intrinsic value, the real underlying worth, and the stock price will follow. It's a long game.
Whereas Wall Street often wants the cash now, the dividend payout.
Often, yeah. They don't always value those retained earnings until they're actually distributed.
And Berkshire Hathaway itself is the ultimate proof of this concept, isn't it?
Oh, absolutely. The prime example. Back in the early 80s, one share of Berkshire Class A cost around, what, $500?
Something like that.
Today,
Okay.
it's around $45,000 per share. And guess what? Berkshire has never paid a cash dividend.
Wow. That entire massive increase came from.
From Buffett successfully reinvesting the company's retained earnings over decades, it's the power of compounding those reinvested profits.
That's staggering. It really drives home the power of letting a great business reinvest its own money. Okay, related to this, the book mentions predictable earnings. Why the focus on predictability?
Because if a company's earnings are reasonably predictable, if the business model is stable and management is consistent, it gives Buffett more confidence in forecasting the potential future returns on his investment.
Makes sense. If earnings are all over the place, up one year, down the next.
It's much harder to figure out what the business is truly worth and what kind of return you can realistically expect. It's just too uncertain.
It ties back to that quote, right? The price you pay determines the rate of return.
Exactly. You need some basis for estimating future earnings to know if today's price is attractive for the long haul.
Interesting, these ideas of ownership, value, return. They're ancient concepts, really. The book even gives a historical nod.
Yeah, briefly. It mentions commerce way back in Babylonia under Hammurabi, 18th century BC.
Wow.
Even then, they had concepts like using property as collateral, making loans with commodities like dates or barley as capital, and charging interest.
So the basic idea of putting capital to work to earn more capital.
It's fundamental. It's been around forever, way
Wow.
before Wall Street.
Okay, fast forward a few millennia to the modern stock market. The book explains the role of stockbrokers.
Right. Basically, when your broker suggests buying a stock, they're doing one of two things. Either helping the company sell new shares to raise money.
Diluting existing owners.
Potentially, yes.
Right.
Or they're just connecting a buyer and a seller of existing shares,
Mhm.
an intermediary.
And either way.
They usually earn a commission, which, naturally incentivizes transactions. More trading, more commissions.
Something to keep in mind. The book uses this example, Katie's Baking Company, to show how companies raise money.
Yeah. Simple example.
Yeah.
Katie needs capital. She can sell more shares of her bakery, which means her original stake gets smaller.
Or she can borrow money, take on debt.
Right. Debt has to be paid back with interest. Selling shares might dilute her ownership percentage. Trade-offs.
But what if Katie needs, like, millions, not just a few thousand? That's where IPOs come in.
Exactly. The initial public offering. The book expands the example plan now. Katie needs $10 million now. She works with an investment bank.
And they sell shares to the public for the first time.
Yep. Suddenly, Katie's baking company might have thousands of owners.
And once you have thousands of owners, people are going to want to buy and sell those shares for all sorts of reasons.
Life changes, views change, need cash, whatever. And that buying and selling is the stock market.
Yeah.
It's created by all those owners wanting liquidity.
Okay, now here's a critical point the book makes. The difference between the price of a stock, what you see on the screen, and its actual value. This gets into speculation.
Huge distinction. That flashing price doesn't always, or even often, reflect the true long-term worth of the business underneath. The market has two main drivers, really.
Investment and speculation.
Exactly. Investment is based on analyzing the business fundamentals, its prospects. Speculation, well, that's often driven by emotion, fear, greed, trying to guess short-term price moves.
And that speculation is what causes those wild swings sometimes. Prices jumping or crashing for reasons that don't seem connected to the company itself.
Very often, yes. The book gives a great example. R.J.R. Nabisco back in 1988.
The tobacco and food company.
Right. Making good money, almost $6 per share, not drowning in debt, consistent earnings history. But the stock was stuck around $45. Why?
The smoking lawsuits. The health concerns.
Exactly. Massive public fear about future liabilities was weighing down the stock price, even though the business itself was churning out cash.
So fear drove the price way below the underlying business value.
Precisely. And management saw this gap. They figured, hey, this business is worth way more. They decided to borrow a ton of money and buy out all the public shareholders at $75 a share.
A huge premium over the market price. They took it private.
They did. They bet that the company's cash flow would be enough to pay back the debt because they recognized the value the market was ignoring due to fear. The book compares it to buying undervalued real estate.
Right. Seeing the solid building behind the temporary graffiti.
Perfect analogy. And it connects back to Graham's point about the market undervaluing companies facing litigation. RJR was a classic case of fear causing overselling and a business perspective buyer stepping in.
Really drives home the need to look past the headlines. Okay, another incredibly powerful idea. Compounding.
Ah, the eighth wonder of the world, right.
Yeah.
The book illustrates it so well. Take $100,000, let it grow for 30 years. At 5% a year, it becomes maybe $430,000-ish.
Yeah.
Okay. At 10%, over $1.7 million.
Big jump.
Now, 15% a year, $6.6 million. And at 20% compounded annually for 30 years,
Don't tell me.
nearly $24 million. From the same $100,000, it's exponential.
That's just mind-blowing, the difference those percentage points make over time. And Buffett's record with Berkshire.
It's phenomenal. An average annual compounding rate around 23.8% for over 3 decades.
Wow.
The book points out, to match Berkshire's after-tax return with a regular taxable bond, assuming, say, a 31% tax rate, you'd need that bond to yield almost 30% pre-tax.
Which is basically impossible to find safely.
Exactly. It shows why those consistent high compounding returns, even if they seem small year to year, build incredible wealth. And why Buffett's focus on quality beats chasing high yields that get eaten by taxes.
Right, which brings us back to that Graham versus Fishermonger contrast, bargain versus quality.
Yeah. Graham was okay buying almost anything if it was cheap enough by his metrics. He might own over 100 stocks.
Spread betting, kinda.
You could say that. Fisher and Munger were about finding those few truly superior businesses, even if they weren't dirt cheap.
The book uses that fat versus skinny analogy.
Right. Graham looked for stocks selling way below their asset value, fat value. But the trick is knowing if it's really fat or just looks fat because the business itself is skinny or flawed underneath.
It's hard to tell true value just from numbers if you don't understand the business.
Exactly. Graham tried to handle this by setting standards, like demanding stable earnings history to make valuation a bit easier, focus on more understandable companies.
The book mentions Buffett's GICO investment early on as recognizing an excellent business. Even within that framework, led to huge returns.
And eventually buying the whole company, yeah. So this quality focus led Buffett to distinguish between types of businesses. Commodity versus consumer monopoly. What's the difference?
Commodity business. That's where price is basically everything.
Pretty much. Think basic materials, textiles, oil, steel, corn, lumber. Customers buy mostly based on the lowest price. Competition is fierce.
Low margins, race to the bottom.
Often, yeah. And brand loyalty doesn't mean much. There are usually lots of producers making the same basic thing. These businesses often need amazing management just to stay profitable.
Like Burlington Industries, the textile example in the book, spent tons on upgrades, sales went up, but shareholder value didn't really follow.
Classic example. The commodity nature of textiles just chewed up the returns. Key characteristics. No real brand loyalty, lots of producers, often too much production capacity industry-wide.
That excess capacity sounds killer. Everyone can make more than the market needs.
Right, so nobody has pricing power until that excess is gone. And then as soon as prices tip up, everyone rushes to build more capacity, starting the cycle over. It's tough.
Okay, so the opposite is the consumer monopoly. What's that?
That's a business with a strong brand or providing an essential service that gives it real pricing power. Think brand loyalty, convenience, maybe a unique formula or process.
The book mentions Buffett's test, Could a competitor wreck this business even if they didn't care about making money?
Yeah, that's the acid test. Could someone come in, offer the same thing for free or at a huge loss, and still not dislodge the incumbent?
Like trying to take down Coke or Wrigley's gum or Hershey's chocolate?
Exactly.
Yeah.
Very hard to do. Contrast that with, say, GM. Making cars is much more commodity-like, high costs for new models.
Right. The book mentions historical examples too, like early Colt firearms or GE in the early days of electricity, or the Gillette razor blade model.
All examples of businesses with some kind of edge, a lock on the consumer or the market.
Okay, so how do we actually find these excellent businesses? The book gives 7 key questions Buffett asks.
Yeah, a really useful checklist. Let's see if I can remember them. 1. Is there an identifiable consumer monopoly? The toll bunch idea.
Okay.
2. Are earnings strong and trending up consistently? 3. Is it conservatively financed? Low debt.
Makes sense.
4. Does it consistently earn a high rate of return on equity? ROE. 5. Does it get to keep its earnings? Retained earnings. 6. How much does it cost just to maintain current operations? Capital expenditures. And 7. Can it reinvest those retained earnings profitably? And is management good at doing that?
That's a solid framework. Let's dig into a few. Question 1. The consumer monopoly or toll bridge?
Yeah, the brand name or essential service people have to use. The book suggests a cool exercise. Stand outside a 7-Eleven or a supermarket. What brands must they carry?
Ah, the things people would complain about if they weren't there.
Exactly. Make a list. Those are potential toll bridges. The book notes service monopolies like maybe dominant ad platforms or credit card networks can be harder to spot initially.
But the principle's the same. And a big warning. Even a great brand can be ruined by bad management.
Crucial point. The brand isn't foolproof.
Question 2. Strong upward trending earnings. The book compares 2 companies.
Right. Company I, steady growing earnings. Company 2, all over the place, big ups, big downs. Buffett goes for Company I every time.
Predictability matters more than maybe some flashy product from Company 2.
Predictability allows for valuation. Wild swings make it a guessing game.
Okay, jumping to question 5. Retaining earnings. Connects to that old Edgar Lawrence Smith book from the 20s.
Yeah, common stocks as long-term investments. Smith's idea was simple. If a company earns more than it pays in dividends and reinvests that difference wisely, the value should grow.
The book's example, 12% ROE, pays out 8% dividend, retains 4%. That 4% gets reinvested.
And compounds. Book value grows, hopefully earnings grow, and eventually the stock price should reflect that, if management reinvests it well. That's the key.
Okay, and related to all this, though maybe not in the initial season, is pricing power and inflation. Question 8, perhaps.
Actively, yeah.
Yeah.
Can the company raise prices to offset inflation without losing customers? Commodity businesses often can't. Their costs go up, but they can't pass it on because of competition.
They get squeezed.
Exactly. Like those ranchers in the book feed costs rise, but cattle prices might fall due to oversupply. Whereas a strong brand, a consumer monopoly,
Like Coke or See's Candies.
they can usually nudge prices up to cover rising costs, protecting their profit margins. That's huge in an inflationary world.
Which Buffett thinks is likely to stick around.
He does. Politicians generally prefer inflation to deflation. So pricing power is a critical long-term advantage.
Okay, back to the market itself. Graham's casino view.
Right. Short-term, driven by fear and greed, creates opportunities for the patient investor to buy below real value. Buffett adds that if the company keeps allocating capital well, its value will rise long-term and the price eventually follows.
The book also talks about manufacturers with unique products.
Yeah, if you make something retailers have to stock, you have leverage. You set the price, let the retailers compete among themselves. Your margins are protected.
Another kind of toll bridge. Reinforced by advertising, creating consumer demand.
Exactly. And then there's another category, repetitive consumer services.
Not products, but services people need again and again.
Right. Think pest control like Orkin, tax prep like H&R Block, maybe cleaning services, American Express. Businesses with low capital needs, often.
They don't need big factories or R&D labs.
Often not. Revenue comes in, they can adjust labor, and the free cash flow can be used for expansion, dividends, buybacks. The book jokes about the reliable drivers. Pests, taxes, dirt, they don't go away.
So for someone starting out, the advice is look at those must-stock brands, maybe unique local advertising, like the only newspaper, and these repetitive service providers.
That's a great starting point. Identify those potential toll bridges in your everyday life.
And the next step is gathering info. Get the annual report.
Crucial first document. Call investor relations, they'll usually send it. unless it's a private company like Chanel, of course. And take notes. Who are the competitors? Who's quoted in articles?
And the surprising tip, actually call those people.
Yeah. Introduce yourself as a potential investor, even if your fund is just you, and ask questions. You might be surprised who talks to you. It's about digging deeper.
So analyze the financials, ROE, earnings growth over 8-10 years, calculate value later, and then do the scuttlebutt.
Philip Fisher's term, yeah. Talk to competitors, customers, suppliers. Get the unofficial story, like checking references before hiring someone.
Or asking the ex-partner.
Exactly. Talk to analysts and institutional investors, too. Get multiple perspectives.
It all comes down to the business economics first, but management quality is still vital.
Absolutely.
Yeah.
Buffett wants businesses so good, even fools can run them profitably. But he also stresses you need honest and intelligent management to actually protect shareholder value. Bernard Baruch quote in there, too.
Right, like Capital Cities buying back its own stock when it was cheap that showed management cared about shareholders.
Textbook example of shareholder-friendly management.
Okay, what about dealing with cycles? Recessions, bad years.
The ski resort example is perfect. One bad snow year doesn't ruin a great resort's long-term value. Same with businesses. A recession hits everyone, but strong companies endure.
Like Wells Fargo in the early 90s recession.
Yeah. Great bank, conservatively run, set aside reserves for real estate losses, but the market panicked about the whole banking sector and hammered Wells Fargo stock.
Creating a huge opportunity for Buffett.
Exactly. He saw the long-term strength through the short-term fear, bought heavily, made a fortune, looked past the temporary storm.
Which leads to market panics themselves, like 87.
Right. Sometimes the market just goes crazy for technical reasons, liquidity drying up, forced selling from strategies like portfolio insurance. Prices disconnect completely from fundamentals.
And those are buying opportunities. Buffett bought Coke in the 87 crash.
You did. Panics create bargains for those with cash and courage.
The book also touches on government, inflation, how printing money devalues currency over time.
Simple supply and demand. More dollars chasing the same goods means prices rise. The candy bar example, hamburger prices.
Yeah.
It shows how inflation erodes purchasing power.
And Buffett thinks it's here to stay because politicians hate deflation, creates the illusion of wealth.
Pretty much, nominal prices go up, but your real buying power might not.
And then taxes take another bite.
Big bite, especially on dividends compared to retained earnings growing value tax-deferred until you sell. Inflation plus taxes really hammers bond returns, as the book shows.
So all this pushed Buffett away from Graham's wide diversification.
Towards Fisher and Munger's more focused approach. Understand a few great businesses really well.
Fisher disliked diversification. Buffett's 10 punch card idea. Imagine you only get 10 investments your whole life. Makes you think carefully.
Focuses the mind. Baruch quote again. Dangerous to know a little about a lot? Better to know a lot about a few things you understand.
So if you find a great one, when do you sell? Not just because you have a profit.
Buffett wouldn't. The adage, no one went broke taking a profit, is true. But you don't get rich that way either, not truly wealthy. Hold great businesses as long as they stay great.
Fisher argued against selling just because you fear a bear market. Taxes, commissions, risk of missing the rebound.
Exactly. Timing the market is a fool's game, as Baruch said. Buy right based on value, then hold, mostly ignoring the market noise.
Though the Salomon Brothers investment was different, more opportunistic.
Yeah, that was a special situation. Preferred stock, high yield, conversion option. Good risk reward for Berkshire at that moment, but not a typical long-term great business holding. It was a calculated bet, a workout.
Okay, so intrinsic value, long-term earning power. That's the focus, not short-term earnings.
Graham said it. Short-term earnings aren't reliable for valuation. You need a long-term view of earning potential. That's where Buffett really excelled.
But even great businesses need good management. Coke in the 70s underperformed.
Until Gozoida came in and turned it around, management matters.
And analyzing earnings history, Graham's Fat Man test. You don't need exact numbers to see the trend, stable or erratic.
If it's erratic, maybe move on. Too hard to value reliably.
The book mentions discounted future earnings but flags the issues. Forecasting difficulty, choosing the right discount rate.
Yeah, it's theoretically sound, but practically very tricky. Using pre-tax bond rates to discount after-tax earnings is a mismatch.
Return on equity seems more practical. The AVSB company example.
Huge difference. Company A's 20% ROE creates way more value than Company B's 8%, especially relative to bond yields. Investing in B at book value just gets you that 8% ROE return, same as a bond, but with business risk. Why bother?
Right. seek high returns on equity. Then there's arbitrage, the workout stuff.
Different game. Fixed return, known timetable, usually. Like a merger deal buy at $30, notes being bought at $50. Your return depends on how long it takes.
Buffett liked high probability arbitrage, even for lower returns. Used it in the partnership days.
Steady profits, downside protection, smart diversification back then.
And the book wraps up applying these ideas to specific companies. Gannett, Freddie Mac, McDonald's, asking those key questions.
Yeah, walking through the checklist. Consumer monopoly, conservative financing, ROE, pricing power, capital needs. Good examples to see the thinking in action.
Lists other examples too. Campbell Soup, Coke, Pepsi, Philip Morris, Wells Fargo encourages getting their reports.
Good homework. Also mentions liquidation, property capital trust, idea sources, Gabelli Equity Trust, contrasts buying power, Circuit City, with true monopolies.
And the final, crucial ingredient.
Patience. Wait for the right pitch, the right business at the right price. Don't swing at everything. Don't get caught up in the hype.
Okay, so summing up the core takeaways. Think like a business owner. Focus on predictable earnings, strong economics, those consumer monopolies or essential services. Harness the power of retained earnings and compounding. Understand value versus price. And be patient.
That's the essence of it, which leaves you, the listener, with a question to chew on.
Okay.
Now that you grasp these fundamental principles, how are you going to handle that fire hose of financial news and advice? Can you filter the noise now? Can you focus on the actual businesses underneath?
That's a great question. We hope this deep dive helps you do just that. Maybe start by looking up the annual report for one of those companies we mentioned. Keep learning.
It's about empowering yourself, really. Making decisions based on business reality, not market moods. That's the path to long-term success.